Thank you, Mr. Chairman. Chairman Powell, as recently as yesterday, Fed Governor Bowman indicated that if inflation pressures remain contained, the Fed should consider lowering rates, and said she is open to a rate cut in July. Governor Lawler said very much the same. Do you believe that we are in a position where we may be able to cut rates in July?
So I would say this. I think if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. The labor market is strong. If we were to see the labor market, meaningfully weaken in a way that was concerning, that would matter for that decision. But if we see inflation, continuing not to move up, we hadn't expected inflation to move up much. We do expect it to move in the summer, and if we see it not happening, we'll learn from that.
The September 2018 Teal book suggested that the Fed, seeing through tariffs' inflationary effects, is an appropriate response so long as inflation expectations are firmly anchored and that the pass-through costs are relatively short-lived. Would you agree that this assessment from the Teal book still applies to today?
I would. Those are the exact factors that we cite when we talk about this situation, plus the size of the tariffs.
Right. So let's assess the current economic situation. The Monetary Policy Report states that longer-run inflation expectations, quote, continue to be broadly consistent with 2% inflation, unquote. And a Harvard study argued that despite the relatively quick price responses to tariff announcements, the overall magnitude of these changes remains modest. So if these conditions hold, is it not unreasonable to think that underlying inflation trends should continue its path towards 2%?
That's certainly a very defensible position. I think what others on the committee think, and what I think, is that this is a question we need to be careful with because it's different than it was in 2018. The difference is that we haven't had 2% inflation. In 2018, we hadn't had an inflation as high as 2% for a decade anymore.
Right.
This is a different situation. We haven't fully restored price stability, and another shock. We have to be careful. If there's a meaningfully large and sustained inflation shock, we have to be careful about that. And so, I think we're just trying to be careful and cautious, and we really think that's the best thing we can do for the people that we serve. If that happens, we need to be there for it. And so, we're in a difficult situation in deciding exactly when to move. But again, if we continue to see inflation come in, and not prove up at the higher levels than we expect, then that would matter for our decision making.
Chairman Powell, economist John Taylor once noted that the Federal Reserve should deviate from its own Taylor rule in the event of an oil shock, similar to the tariff scenario. A one-time price increase from an oil shock should not be accompanied with an increase in interest rates. Do you agree with that assessment?
I generally do, yes.
Previously, you said that if you wait for inflation to get back down to 2% to cut rates, you are already too late. You also said in November 2024 that inflation was on a sustainable path to 2%. Given that the FOMC believes that interest rates now are moderately restrictive and that an oil or tariff shock may not impact underlying inflation in a significant or meaningful way, because as the Monetary Policy Report established, inflation expectations are firmly anchored, what is the reason not to cut rates?
Well, it's uncertainty about the size and potential persistence of the potential but highly uncertain inflation from tariffs. By the way, we have 5 Taylor rules in the Monetary Policy Report. 4 of them say that the policy rate is in the right range, and the other one calls for a hike.
Right.
Just for the record.
Well, back in the beginning of the Biden administration, when we talk about inflation, they increased federal spending by $2.5 trillion each year. $5 trillion in new spending. That's what gave us inflation, by printing all of this new money and borrowing, and yet You did not respond to that by raising rates. In fact, you were late to raise rates. And now, again, we see a situation where
Gentleman's time
you are
is-
late to cut rates. That is the challenge here.
Gentleman yields back. Chair recognizes the